Good to see you. This is Peter Carsten, the CEO of STARTRADER. Really good to see you. A number of you have asked me over the last couple of weeks, what happened with Silicon Valley Bank? What is it actually that's going on in the banking sector? We've seen Credit Suisse be taken over for $3 billion, which for a company formed in 1856 is probably the slowest unicorn startup being sold or realized that I've ever heard of, but okay, great. That happened, but what happened with Silicon Valley Bank? So here are a couple of slides to give you a sense of what's been going on over there. It's quite an extraordinary little story. We at StarTrader don't trade in the United States, so that's not one of our target areas. But we do serve markets where 5 out of 8 people in the world live, so that's rather nice. Let's focus in on Silicon Valley Bank exactly. What is it that happened? Well, the starting point there is that quantitative easing has been used for quite a long time now in order to try to drive investment worldwide, and that hasn't quite worked the way that people wanted to, because the low central bank interest rates have caused money to instead be diverted into real estate and shares and things like that. So that's been quite an interesting thing, and a small percentage of that has drifted into things that make up inflation, which is why we're now seeing big inflation in many markets. And central banks are trying to respond to that increase in inflation. UK inflation went up in February again against expectations now in 2023, so it's quite an interesting world we live in. But it's difficult to raise the interest rates because it hits investments and it can hit other companies as well. And that's where Silicon Valley comes into this. Silicon Valley Bank comes into this because Silicon Valley Bank is a company where in the fourth quarter of 2019, there were $62 billion of deposits from startups and VCs, and that grew to $189 billion at its peak in the fourth quarter of 2021. And Silicon Valley then, quite prudently, put a lot of that money into long duration government bonds and securities, where quite small parts thereof relatively were available for sale. So these were long-term treasury bonds and mortgage-backed securities that they invested their money into. It was a very good business, very nice business. Until in 2022, the central banks started raising interest rates, and things became a bit tricky because there were deposit outflows. Companies were using up, they were burning through money, and 2022 had quite tough private capital markets. And assets were risk-free if held to maturity, but of course they were not intended to be withdrawn shortly. So the asset value, the face value of the asset value went down quite a lot. And things became quite strained during 2022, leading into January, February, and ultimately the 8th of March. And this is where showdown really happens. The 8th of March was a crunch day. On the same day, at the close of play, post-close, Silicon Valley Bank announced that they would raise $2.5 billion, primarily through the sale of common equity, some private investment and convertible bonds. And in that same paper, they also disclosed the loss of $1.8 billion when selling almost all of the assets that were available for sale, all the AFS. Now, that was not well received overnight from Wednesday the 8th into Thursday morning. So on Thursday morning, the 9th of March, there was a big share price crash immediately down by 60%. Big change, big change. And some leading venture capital companies told their clients that it would make sense to pull funds out of Silicon Valley Bank. And people did. These are technically very capable people, so they literally used their cell phone apps to swipe out $42 billion in one day from Silicon Valley Bank. An extraordinary number. And on the 10th of March, consequently, the share price down a further 69%. Silicon Valley Bank had to say, okay, that's it. And the regulator took over, appointed the FDIC as a receiver. And that was the close of play for Silicon Valley Bank. Major movement. And that's just Wednesday, Thursday, Friday. Incredibly fast. And despite that, I can comfortably say that there is money in 2023 because, as you can see from Silicon Valley Bank, raising the interest rate can have big effects, not only on investment, but also on the banks that rely on a low interest rate. It's a very sensitive system. So the conclusion is that during 2023, there's a lot of money in the market, and one of the reasons is that it's so very difficult for the central banks to raise the interest rates and pull down the inflation that we're seeing worldwide. So it really, for me, Silicon Valley Bank underlines that 2023 and 2024 look like the best years ever for traders. So welcome on board. If you're not with us already, then please join us now. And thank you very much for taking part in this little presentation. Thank you very much. Thank you.